Well, I think it's probably a bit early to say that the bubble's in the making. I mean, clearly we've had COVID come under control. We've got a high degree of both domestic and global stimulus, monetary and from a fiscal perspective. So that's providing quite a lot of liquidity into the market. The valuation gaps are still probably at the higher end of that, sorry, the lower end of the gap to the US market. So we still think there is some room here. And one of the things that we're seeing that we think is actually quite a positive is a broadening of the market. So although we have seen a lot of the concentration into the high-flying growth stocks, and you've commented on some of the IPOs this morning, but we've also seen that start to leak into other parts of the economy, where that's been the cheaper property stocks and some of the financial stocks. And we think that that's showing a good sign that the economy and the strength of that economy is broadening out a bit.
Right, Joshua, but typically, in a bull market, the last phase of the bull market is marked by these big ticket IPOs coming to the markets, and also the kind of oversubscription numbers and the kind of pent-up interest that support these new issuances. And so, is that not what we are seeing right now, or is this time different?
Yeah, it's always a brave thing to say this time is different, and some of those warning signs are out there. You know, whether we look at the US market, where we've seen a bit of a narrowing of the market, they are concerning signs, and I think we do need to be aware of that. But again, I sort of come back to the point that there are a lot of quite cheaply valued stocks, whether you look at some of the property stocks or the financial stocks or some of the other cyclical industries, which have obviously had their earnings hit quite hard. Now, if the economy is starting to broaden out and those earnings are starting to get better, and the market is moving some attention away from some of the high-flying consumer staples and healthcare and into those cheaper parts of the market, we think that's actually quite constructive.
Joshua, I'm wondering how much attention we should pay to the messaging coming from the government. I mean, talking about the state-sponsored China Securities Journal on the start of the week was giving an indication, almost an all clear, talking about a healthy bull market. And then yesterday, an opinion piece seemed to be warning investors to look for the long term. It seems like there's a little bit of concern there, perhaps, that things are getting too hot. I mean, how do you read this?
Yeah, I think in a lot of ways it's quite a difficult problem, because as I was just sort of mentioning, I think in some parts of the market you're having quite a lot of like extreme valuations come and sort of like the animal instincts are very, very strong. But then in other parts of the market, there is quite a bit of value, and I think it's, as we've sort of seen, as the market really narrows around the focus on the stimulus and I guess what we call the COVID beneficiaries in some of the tech parts of the tech sector and healthcare, is that can get a little bit frothy. But then other parts of the market have been left that are quite cheap. So when we do see that people are spending a bit more time thinking maybe the economy is getting better, maybe the earnings for these cheaper companies could actually start to surprise on the upside, and seeing some flow going into that sort of part of the market, we think that's actually quite a big positive. But you're right, if the economy continues to be weak and people are just focused on the liquidity going to those high-flying, quite expensive stocks with a high degree of retail sort of involvement, then we do need to be a little bit more cautious.